In recent years, large cap stocks have dominated market headlines. The concentrated group of mega cap technology companies drove much of the performance across major indexes, and for good reason. Many of those companies earn investor attention through strong earnings, dominant market positions, and durable growth. But that level of concentration raises an important question for long-term investors. Is your portfolio positioned to participate beyond the largest companies in the market? At 1900 Wealth, our team of advisors helps clients think through exactly that kind of question. Small cap investments are one area that has re-entered the conversation, and understanding their role in a well-constructed portfolio is well worth exploring. Small cap stocks generally refer to companies with market capitalizations between approximately $300 million and $2 billion. These businesses are often earlier in their growth cycle, which can mean far greater expansion potential. But it also means greater volatility, lower liquidity, and more sensitivity to economic conditions. So why are investors paying attention to them now? One reason is market concentration. When a narrow group of companies is responsible for a significant share of overall market returns, portfolios can become more dependent on a small segment of the market than many investors realize. As participation begins to broaden across sectors, company sizes, and investment styles, smaller companies may play a more meaningful role. Valuation is another factor. While large cap valuations expanded significantly in recent years, particularly within the growth sector, small cap valuations have remained more constrained. That gap can be relevant, but valuation alone is never the whole story. At 1900 Wealth, we evaluate valuation alongside earnings quality, balance sheet strength, profitability, and long-term business fundamentals. A lower price doesn't automatically signal opportunity. It has to be understood in context. Interest rates also matter. Small cap companies have historically been more sensitive to borrowing costs. Many rely more heavily on floating rate debt and have tighter margins. The recent rate hiking cycle has created real headwinds for smaller businesses. If rates remain more stable, some of those headwinds may ease, but selectivity still matters. Not every company benefits equally, and not every lower valuation is a compelling opportunity. There's also a domestic revenue dimension worth noting. Small cap companies often generate a larger share of revenue within the US than many large multinationals. That can reduce certain global exposures, but it doesn't eliminate risk. These companies are still exposed to domestic economic conditions, consumer demand, inflation, and financing costs. The more important question is always whether a company has durable fundamentals, a sound capital structure, and a clear role within your broader portfolio. For long-term investors, conversation around small caps shouldn't be about timing a rotation or predicting short-term outperformance. The better question is whether your portfolio is appropriately diversified and positioned to participate in opportunities across different areas of the market. At 1900 Wealth, small cap exposure is evaluated as one component of a broader strategy, always in the context of your long-term goals, risk tolerance, liquidity needs, time horizon, and overall portfolio construction, because the right allocation is never a one-size-fits-all. If you'd like to review how your portfolio is positioned for a broader market environment, our team is ready to have that conversation. Call us at 210-736-7770 or visit 1900wealth.com.